Hey guys, this is Julie, J Trading Strategies. It is Friday, July 27th. What a day today. And I got to tell you that my 30-second chart, my JATS LRT bands, LRT lines indicator, the linear regression indicator, picked the bottom. Let me show you. We were able to tweet that out this morning, right around 12:08 a.m., 12:08 p.m., right after lunch. We had flushed down to, of course, S3, got the 3-minute bottom here. The momentum came in, so that St. Mom 3 was all green at the time. And I have a screenshot of it. I'll pull it up and show it to you. And I look down here at my 30-second chart, 12:08, 12:08, 12:08, and right here we got the crossover. Okay, got the crossover indicating a new direction, a new cloud forming with that 3-minute reversal candle. With everything was red except for the St. Mom was all green. The algos all kicked in at the same time. And so obviously we were at a location indicating a reversal. And so I was able to easily pick the bottom, pretty easy, well, considering that we sold off all day. It could have gone down lower, but sent that tweet out and it held the whole dang day. Look at it. Came right down to the bottom, held the 2810. In fact, I even sent the tweet out calling 2810. Hold on just a second. Actually, 2 tweets. First one I sent out showing the 3-minute momentum, and then the second one confirming it when I saw the linear regression changeover. And I actually tweeted out the 2810 support. So gotta love it. Gotta love that 30-second, the indicator. This stuff is real, guys, and it held, came down, touched it, and then off she went. And she held the whole, she came down to test it, but never broke the 2810 and then took back off. So it withheld the test. My little 30-second LRT lines. I guess I should, y'all should be lucky that you have this, right? So we all should be lucky we have this. Just goes to show you. Now, again, I did tweet the guy and say that was a 30-second chart. It could easily have crashed through it, but it held. It held. It sure did. So, right there. Let's put this back over and start the whole darn day. Okay. Quit bragging about my tweets. Okay, so here we had the open after the great GDP number. So we got the 4.1%. And if you're wondering why, like I was earlier, why did the market sell off? Apparently, a good percentage of that GDP number, 1% of it, was comprised by soybeans being purchased in advance of those extra tariffs going into effect. So apparently soybeans were sold in advance of tariffs hitting the market. So I don't think that the entire 1% was that tariff purchase. I think soybeans normally are purchased during the quarter, but with the, you know what I'm saying, normally you have a certain amount of soybeans in your agricultural products sold during the quarter, but it ended up being a total of 1% soybeans in that quarter. And so it's not the entire 1%, let's just be clear, but a good chunk of that top portion of it. So I would say maybe half of it, or I don't know, I'm just guessing, was a result of that tariff trade. So I have to get into the weeds and look at it. But so the number most likely would have been 3.5, maybe, without that extra oomph added for that soybean trade. So, but it's still showing us that the growth is coming into the market because the consumer spending was so big. And also, we don't have to worry about next month falling like Bloomberg economists are saying we're going to get a terrible GDP print for the third quarter. That's crap. I'm not even an economist and I can call that crap on a stick. Don't believe it. They've solved the tariff problems. The EU, Mr. Juncker, Jean-Claude, and President Trump stood at the podium, told us that they're working on those tariffs and they're going to lead the rest of the world to show how free trade should work. And we're negotiating with Mexico. NAFTA's already going to get done before the end of the year. So all of those headlines are going to be coming out. So don't believe this crap that we're hearing from Bloomberg saying that it's going to be 1.5 or 2% GDP next quarter. That's ridiculous. That's just ridiculous. So these economists can sometimes get way overblown. I don't know where they're getting their stuff from, but not with the strong consumer spending that just came out also. So the market's taking off, people are getting employed and they're spending money, and the trade deficit is reducing. So there's no way that it's going to be anything short of a 3% annual print. And if you're wondering why I'm getting so excited about this, it was in May of 2017 that the Los Angeles Times posted that, you've got to see this. Let me pull it up. Okay, sorry about that. I get so excited. Here is the article, May of 2017, right? Los Angeles Times. And it says if Trump thinks he can get more than 3% economic growth, he's dreaming, right? And what they're saying here inside the article to base that conclusion is an estimate from the Congressional Budget Office forecasts an annual average of about 1.9% well into the next decade for the next 10 years. Everyone thought that we would only get 1.9%, that's per annum, well into the next decade. Well, we're already at going to be 3% this year. So we've already got there 1 year later, just 1 year later, barely, July, 1 year and 2 months later, we've already hit that projection. So we're on target for a 3% growth this year. So, and it's because of the Trump policies. So I have to, slow myself down and pause every time I hear an economist come out and say some crap like, it's going to be a horrible quarter next quarter. It's not. We've got a change in the regime, a new sheriff in town. All these jobs have repatriated back to the United States. all this money, the earnings that just came out. I mean, are you kidding me? Forget Facebook. We had a few misses. We had Intel missing. We had Exxon missing. We had Facebook missing. But really, Facebook didn't even miss. Facebook beat its earnings. It's just missed a little bit on the revenue side. And it showed that they had several billion users. I mean, seriously, I don't know why the market punished them like it did. But did you see the Amazon, numbers? Just $5 billion in a quarter. Are you kidding me? Five, and they were expecting two. $5 billion in a quarter. So yes, it's just amazing. So sorry, earnings per share 5.07 billion versus the 2.5 billion estimated. That's the EPS. Revenue was 52 billion versus 53 billion. I mean, it's just like splitting pennies. But the AWS revenue was so strong that came in at 6 billion. 6.1. So they're growing that Amazon Web Services data center very, very much. So the great earnings reports have been coming out, great growth numbers. Don't listen to Bloomberg when they're telling you that we're going to have a flat quarter next year. You'll be the only one left on the sidelines if you do, but I can't encourage you to start buying if the whole market is selling off. That's not going to work either. So let's take a look at some larger charts, and always, as always, trade what you see, not what you want the market to be. So we're able to, participate today in the rally, in the sell-off in the room today in the NASDAQ. So always trade what you see, not what you want the market to be doing. Let's take a look. Let me get some of these. Let me get a different template on my chart. Okay, here is the daily chart let me get a few more days on it. When you put a daily chart and you see this big balloon on the indicator, that means we don't have enough days. This is a very sensitive indicator, and you have to have enough days coming through for it to work. So just increase your number of days and that should fix it. So we see that is that poopy diaper candlestick pattern that everybody's going to sell next week. I think they have a name for that. But when you have a little tiny bar and then you have the opposite red bar down day, that means sell. So they'll probably sell it. And what the linear regression pattern is we're still in our sweet spot and we're moving up. You see that? So it's definitely going to bounce once it hits this line. And then here this is going like that. So it could hit that line, bounce, and then come in to the cloud and hit the bottom, wherever that bottom's going to be, like that. Draw my lines again. I'm sorry, here, this is the line. So there's your channel going out in the future. So it's going to come in and it's going to bounce on this bottom. Hopefully, and go back up like that. That's best case scenario. If it crashes this bottom, like here, it was up, 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 and then it came down. Do you see how it first went to the first bottom, came back up, and then went down? See how it went, touched the bottom of here, went back up, and then went down through it, hit this and went, stopped on the close, and then opened on it and went all the way down, then coming down to the trend filter. And this is where the institutional players come in and buy. That's the 200 EMA, and that's anytime you get on the 200 EMA, you're going to get institutions buying. But I don't think they're going to lose all that market share when we have a 4.1 GDP. I don't think that's going to happen. In fact, it's likely to just bounce on this top line. First time it hits it, it's going to come down here, hit it, and then bounce up. So just be ready for, if you're selling into it, be, in the room and understand where these lines are. But if it does break into the cloud, it'll come down to that second line and then bounce on this bottom one. So we'll just have to wait and see. And if you want to see what that looked like going back, here was the, you see how it stays in the cloud? And then here it got underneath the main cloud. And here was the sell-off. And it didn't sell off. It would have sold off, but guess what happened? QE. The government was in charge of these markets. It would have sold off here and here, but do you see that the main trend line flipped to the top, and you're underneath, you're in a downtrend all this time. Hard to say with these lines. Okay, do you see how it flipped under? And the main, this bottom one went underneath it. That's all artificial. That's all artificially driven price action, that whole time period between March of 2017 through September of 2017 was all artificial. That all should have come down. That's where the market naturally should have come down when you see that crossover, that linear regression crossover. We're nowhere close to that happening. Nowhere close to that happening. And I don't think that they're going to allow that to occur anymore. But we are on top of the band. You see how we went underneath it here? And then it bounced on your institutions coming in. Where did it go? Right back to the trend filter. I mean, the LRT bands, the lines. Where did it go? Right back to the middle. Where did it go? Right back to the top. Came in, went to your trend filter, picked it up, went to the top of the band, back down. I mean, there's a reason I have these indicators on my chart like I do. They tell us where the market's going to go. And if it does crash through again underneath it, this was your correction. And here, and that here, meaning June 4th, 2018, we went out of correction mode. We came back to test. The line stayed above, dipped under a little bit, but the line stayed above. And this bull bar right here with that gap, and this is probably what's going to happen now that I see it. I'm sorry, I didn't see this. Here's your target, that gap line. So it's going to fill that gap line. We have that gap up, and here is the bottom gap that was tested and never filled. $27.72.75 and $27.87.75. The close is $27.87.50. So there's your gap. And what we want to see is that gap to close, because the market doesn't like to leave a gap. But if it leaves a gap and goes up, that's very bullish. They may elect to it may come down here and try to break it, but not break it. It may turn around. If it leaves the gap alone and goes up, it's going to go after these stops up here at the that have been sitting up there on the high at 28.83.75, and then it'll go back down for it. You know what I'm saying? But we know where the market's going. It's going for our gap line, likely target. And I could not trade without my market analyzer or my LRT lines indicators. So, I mean, that was pretty impressive that it was on a 30-second chart and picked the bottom with my market analyzer and my little templates. And that's pretty powerful to have, don't you think? We got to learn to trust this information. This is on the LRT4. To see the LRT all, this is the section that we wanted to be trading. Right here. Or you can trade the one and stay in it longer, but on the one, you might get batted around a little bit. But definitely the 4, know where the all is. I mean, the all. And the 4 is your reversal. Right? The 4 tells you the reversals. And if you want to see what it looks like for the indexes, RTH, this is showing you that the trend reversal has occurred on the 3 minutes, and there was your all. Great, great template. It's like one of the best, I keep saying, the best thing I've ever done in my life is get BloodHound and start creating these templates and create them on my own, not using other people's ideas, but use my own trading ideas. Hello, hello, hello. Yes. So let's look at the NASDAQ on the daily and see if we can find where that might be coming in. That had a bigger down bar, and we went through the first level of resistance. See how it was holding the channel? So it broke inside the cloud, and where did it stop? I can't make this stuff up, people. Right here. Look at that. So this is where we're going to stop. It's going to stop and go back up. If it does break down, if we do get a down close on Monday, coming after these stops, 7,000, this line is going to be rolling over, but I'd be watching for that to stay on top. We've already crossed up, so we are long. We are looking for longs. As long as this stays above that line, once that rolls back over and down, we're in a short, in an uptrend, in a down condition in an uptrend. So we want to keep it on the right path, the right target, and that is long, long, long above the line. And so what we want to see is something like this, where it comes and bounces up. We don't want to see this roll over. So you see how it went underneath the big bear bar here? Um, and again, the market was still being manipulated back then. The QE, the Federal Reserve, was driving the markets. There's no way that they were going to let the market crash. They're not doing that anymore. That's what all this is. We had a new sheriff in town, and his name is Powell. And he's allowing he cut the strings, and the market realized for the first time in like 10 years that it had the ability to free float the market again. And that's why we had all that crazy price action in 2018. So the market is driving this again. And I got to tell you, with 4.1% GDP and all these great earnings that have come out, I will be shocked if this crosses back under so soon. So soon, if it does cross under, and that this top line, the LRT, 4 crosses the 1, this is the 1, and that's the 4. If the 4 crosses the 1, if you get a 4-1 cross to the downside, so like that, 4-1 cross to the downside, it's coming to the trend filter. It's going to come all the way to the trend filter. Because it's going to blow out those stops sitting there at 7,000, and the trend filter is going to be already up there. So we already know where it's going to go, but I don't think it's coming back down for them right now. I could be wrong, and it could be headed there already, but we'll just have to see. But it's nice having an understanding of where the market might be going. I don't have any more gaps on the NQ to close. That's why I was surprised. I didn't realize about that ES gap. Okay. All right. So, and then on our normal day-to-day trading, you can trade this with your 3-minute chart and your high-low 2 templates. So come check us out in the trade room. We've got a ton of economic indicators to trade next week. So let's take a look at what we've got next week to decide in advance if that market is going to crash through or hold up. And we have got on Monday very light and pending home sales. We've had very disappointing home sales numbers, and so this is likely to miss. And so we could have a down day on Monday. I just got to tell you in advance. On Tuesday, we have a lot of overnight European action. So if you want to get up, Tuesday and Wednesday night are going to be the great European session days to trade. But we've got our PCE numbers, personal income numbers. So the Fed loves these PCE numbers to see if there's going to be any inflation coming into the market. That could be another indication that the market gets spooked if that PCE picks up. We had some strong consumer numbers in that GDP report, so if they see that personal numbers rising, that could spook the market. But on Wednesday is going to be another big day. The manufacturing PMI comes out. European session as well as the US session, and the ADP non-farm employment change numbers. The ISM manufacturing PMI can set the tone for the entire month like it did last month. we got a killer number out of the park. We got that 60 print last month, and that propelled our market up higher all month from July 2nd on. And if you want to go back and look from July 2nd to the current trading session, right here, we got that great ISM manufacturing report number right here, July 2nd. You see that big bull bar, and that propelled the market up all month. I told everyone in the trade room last month, I said, you wait, we get a good ISM number that's going to just propel the market up, and it rocketed it up. So we got the same opportunity to save us on Wednesday. So if they sell the market off, that might be Wednesday that it gets down to 7,000. And then we get that ISM manufacturing that's going to save it and propel it back up. So y'all are listening to it here first, right? So if it comes down here, wait for that ISM manufacturing number, and then it'll take off again. And then Friday, we have, and they're expecting 59.5. So, which is a very strong number. So anything 59.5 or above to save the markets. Got to pray for that ISM manufacturing on Wednesday. Crude oil inventories, FOMC statement interest rate decision on Wednesday. That's going to be another big market shakeout. The Fed could actually come in here and save the markets, save this rally, and allow that growth to take place by calming the market and keeping everybody's, expectations on track, that as they have in the past reports, saying, yes, we have a slow and gradual intention to raise rates upon this normal growth, but we're not going to choke it off. We're going to allow the market to run a little bit hot. In fact, it hasn't been a little bit hot yet. So they've got a little bit of that extra push on the string left in them because we haven't run hot yet. They've already told us that they're going to let it run a little bit hot. So they could get a little bit of that PCE coming in, and they just need to be telling everyone that it doesn't matter. They were going to allow the market to run a little bit hot. They're not going to like yank this growth off the table. So the Fed has everything in our market's trajectory depends on the Fed statement on Wednesday. It really does, because they could choke that growth off or they can let it run. So hopefully they're not that stupid. I mean, they are economists, but they have to allow it to run its course on a normal path. And then Friday we have our non-farm payroll. So 7:30, and they're expecting 190,000 jobs. So we could we could easily get everything back on course with a strong non-farm payroll on Friday. So if it's like over 200,000 again, and the participation rates are already up really well. So and I think we will I do think we're going to beat the report on next month's report. I do think we'll beat it. So we have some great economic numbers to trade next week, and a picture of where these markets are heading, and hopefully get this turned around. We have ISM manufacturing that can turn it around on Wednesday ahead of non-farm payrolls. If we get the ISM manufacturing to give us a big pop like we got last month, and then we get that non-farm payroll right behind it to confirm another big win, then we're getting, into the serious numbers where I think that we could, be looking seriously at some great numbers up here. So 8,000 right there. And on the ES, 3,000 right there. Got my line already on it. Goldman Sachs thinks it's going to be there. I think it's going to go ahead and get it. And I think that's by the end of the year. Okay. But we don't want it to come all the way back down to the 200. Why waste all this market cap? Why